Okay guys, welcome for the weekend review, stock market technical analysis. I'm going to go through how the markets closed the week. We'll look at a couple weekly charts, look at some individual trade ideas and setups for next week, and we'll wrap. So I'm going to start out here with the DXY, the dollar. So I'm really focused right now on what the dollar's doing, and the bond market looks extremely interesting. So I'm going to cover that. I think there's potentially really big plays coming based on those charts. So the DXY, here's what happened on Friday. We obviously, Friday the dollar fell pretty much all day, down about 0.5%. That's a good sized move in the dollar. And the markets rallied on that dollar weakness. Again, the markets continue to rally on dollar weakness, and they're not going down on dollar strength. However, I'm watching for continued dollar strength. If we continue to see the dollar moving up, then the market's likely going to pay notice. I think the line in the sand for the dollar is this 92. It's about 92.10, 92, somewhere right in there. That's basically, if I roll out and look at the daily chart on this DXY, we held that shelf of support for quite a while. This is going back from July till about November, so several months we held, and then we broke down. So the furthest this up move should go is about 92. If we start to break above and the dollar starts to rally above that 92, then I think it's an extremely high probability, if the market has not paid attention at that point in time, it will start to pay attention, meaning that stocks come down, and they'll likely come down pretty quickly. So that's what I'm watching until we break that 92. I don't know if the market's going to pay attention and really care. The thing is, a lot of people are positioned for dollar weakness, so they're seeing this as just a counter trend rally as part of the larger trend of dollar down. And it's obvious. The dollar's in a downtrend. You've got this downward move really ever since the Fed came out and started to create, their quantitative easing program. We can build what looks kind of like a bullish falling wedge on the dollar, and that is something to take note of. I'll have to kind of tighten that up. But the point that I really want to make is just the shorter term time frame. We have this is the bullish falling wedge that I spotted a while back in the dollar, in the DXY. And when we got into this area right in here, we started to put in the bullish divergence. See the bullish divergence, how momentum started to move higher, and yet the price was continuing to go down. The dollar was continuing to fall. That's price diverging from momentum. So we look for divergences to give us a cue that there's a potential change in trend. And then once you see those divergences, you wait for a break of trend support or trend resistance. And so trend support was right here. You can see it's just a nice clean downtrend line, and we broke right here. So an impulsive 3-day breakout, slight consolidation period right in here, and then a continuation of the uptrend. So on Friday, all we did, what it looks like to me, is we came down and hit support, which is about 91. I've got it at 90, 94, but we came down, hit that support, held above it. Technically, nothing has changed. We're in at least a short-term uptrend where the dollar's kind of moving up in this upward price channel. Longer term, longer term, medium term, whatever, since last March, we're in a downtrend. So that's what I'm watching. 92, a break above 92, which is not too far up there. A couple days we could be up there, and you're likely to see some chaos in the market. We break this lower trend line right here, start to break down, and we'll likely continue the downward momentum in the dollar. If the dollar starts to break down, look for gold proxies like gold mining stocks to start to rally again. And I am watching that because I think it is interesting that gold is starting to set up for what looks to be like we're getting close to a buying opportunity in gold. Gold bullion here, I just want to point it out. Here's what I'm looking at. We do have bullish divergence. Let me here's the RSI. You can see how it's confirmed, how the RSI started to turn up. So we have upward, we have a new higher low right there, and then the previous low. So we have an upward momentum on the PPO and the RSI, and price has continued to go down, but it's not diverging yet. I misspoke. We need to see a slightly lower price in gold. So what I'm looking for is a price undercutting this most recent low of 17. It's about 1776. I think if we can dip down into that area, 1750, 1740, anywhere in that area, if we do that relatively soon and we set a new higher low, we will have that bullish divergence. So I'll point it out in a video if it shows up. If it doesn't show up, then we could continue moving down. This could just be we could see a small little bounce and then continue to move down. I am thinking that we are going to get that price around 1750. It could actually go all the way down to about 1730, 1700. I don't expect it to go much lower than that. If it did, something would have changed and we'd be wrong on that call. But as of right now, that's what I'm expecting. Slightly lower prices. It's only about $50, $60 from where we're at, which we can get there in just a few days. So keep an eye on that. That's important. Gold on Friday just had a small bounce off of its support. This is major support. It's 1790 area. I've talked about that level for a long time. We hit that level again and got a bounce reaction. But the bounce is relatively muted, so we'll see what kind of continuation we get next week, or if it just starts to roll back over and hit that 1790 again. We start hitting that level again, I think we are going to get that slight little undercut one of these days coming up. From my perspective, as far as I can tell, and prices down around that 1750, that's the buy zone from my perspective. Okay, bonds, especially the long bonds. So we'll start out looking at TLT. This is the 20-plus year Treasury ETF. It's just tracking the long end of the yield curve, the long duration bonds, so 20 to 30-year bonds. These are very important to watch because, if we continue to see downward selling in the long bond, there's going to be some problems in the market. The entire market is based on cheap credit. And when I say credit, I'm talking about money and interest rates and bonds, essentially, cheap bonds. That's why the Fed is buying Treasury bills. They're buying a lot on the short end of the curve. And the long end of the curve, they're not really doing as much buying over here. This is a little bit closer to free market where, and bond holders are selling the long bond. So to me, when I see this, that says the long bond holders are seeing inflation. That's what this is saying. It doesn't mean it has to continue, but they're worried about inflation, because inflation will eat away the value of their bond. If you think inflation is going to come on serious, you don't want to own a bond, a 30-year bond, and then in 30 years you cash in that bond for your principal. And that principal can't buy you anything because inflation ate away the value. So that's what this is saying. That's why that's why I'm really starting to focus in on gold. That we could be ready for the next leg up in the miners. And when they run really good. So right now, if we look at the hourly, you can see just straight slide. This is a good size move in the bond market. Really from the 27th of January to Friday's close, a 4% slide. That's a good size move. So we're going to start to hear more about what this means. On the hourly, I don't see any bullish divergence on the hourly in the RSI. The PPO does have it. It's not confirmed, but you can see here, right there, we made a new lower low in price right in here, and yet less higher low in the PPO. So there's bullish divergence as of right now. It's not fully confirmed, though. You want to see the PPO start to turn back up to confirm that. And the RSI does not have it on the hourly. If we look at the daily, we do have bullish divergence as of right now on the daily. You can see it right there, and here's the RSI as I zoom in. It's just ever so slightly higher. However, it's pointed straight down. You can see the RSI is pointed straight down. So unless we have some sort of a snapback in the bonds, then we are likely going to burn through this divergence, which as of right now, I think that's probable. We're going to continue to sell off. And if we do continue to sell off, then it's just a straight downtrend in the long bond. I don't see any divergence, any reason why we would, reverse that trend, at least not in the charts. Now, we do have some support down here at 146.23. You can see on the daily, we've just been walking down that downtrend. So if we hit that, we'll probably get a bounce and a reaction there. But that doesn't mean that the trend is going to reverse. That just means that that's a bounce within a within a downtrend. So bonds are important because they reflect interest rates. And here we're looking at the 10-year Treasury interest rate. All right. So when you look at the, a lot of debt instruments are hinged to the 10-year Treasury yield. Car loans, credit card interest, I believe is, mortgages. They all tie these to the 10-year Treasury. And when the interest rate rises, then essentially the cost of that debt rises as well. So mortgages rise, auto loans, and if people are struggling to pay for things now, let's just put it this way: with mortgages, when interest rates rise, house prices fall. There's an inverse relationship between house prices and mortgage rates. When mortgages fall, house prices go up, and vice versa. And so we are seeing mortgages start to rise because the 10-year Treasury is starting to rise. Here's kind of a line in the sand. You've got this downward trend line right here, and this comes back from 2018, November of 2018. This is basically when the Fed started cutting interest rates. Right here, they were raising interest rates back before that, trying to unwind their balance sheet, and then they did that. They did the Powell pivot, is what it's called, where he basically changed course and started cutting interest rates when the market dropped 20% in late 2018. And I can show you here on the SPY real quick. It's right here. That's when we broke the bull market trend back in 2018. So going back to the interest rates, so we've been in a downward trend ever since that time, and we're coming back in to test that trend line right now. So on Friday we closed right at the trend line. So this is a key moment. That's the point that I'm trying to make. If we break higher and we break to the upside, interest rates are going to start to rise, and that's going to be problematic for a market that's based on low interest rates. And a lot of the market expansion over the last couple of years in 2019 and in 2020 has been based on the Fed dropping interest rates, and so it's called multiple expansion. And when interest rates fall, essentially businesses can borrow cheaper, and their stock price goes up basically. So if interest rates are rising, and they're not rising because the Fed's raising them, the Fed's controlling the low end of the curve. They're rising because the bond market, the long-term bond holders have been dumping bonds pretty quickly. So watch that, because there's potential risk there. On the, if I look at the RSI, as of right now, there is negative divergence right there on the daily. So you can see that we have made a new high in interest rates, just slightly right there, closing on Friday, a new high, and we did it on less momentum. So this could be the end of the road. We're at resistance. We have negative divergence, and this is a divergent high in interest rates. So everything that I would look for is to say, okay, this has a higher probability of failing. So watch that. We got to watch this trend line and this resistance line and see what happens. If interest rates continue higher, then you have the possibility to burn through the divergence, and that would be pretty bullish for interest rates and bearish for a lot of markets. As interest rates rise, there's going to be a lot of problems. So these interest rates really need to stop right about here. Otherwise, we're going to probably start to see some risk off in the markets. I would suspect if these go too much higher, the Fed's going to come out and say they're going to buy the long end of the curve. They'll call it a twist. They'll say we're going to do another operation twist or something, but that's where they'll sell the short end of the curve and buy the long end. Or they might just come out and say we're going to buy the long end of the curve as well. That's called yield control, interest rate yield control. They might do that, but I would suspect if we continue higher, then we're going to hear something from the Fed. Okay, now that I've gone into kind of the general thesis, let's look at some charts. Here on Friday, Q's closed basically at the top of this wedge. I've got this wedge coming off the September 20 highs. It's a bearish rising wedge, not that well defined on the upper end, so we could extend. This could continue to kind of expand. I'm not using the top end as much of a as an entry point or anything like that. As of right now, I'm looking for another breakdown of this lower trend line right here. That's much better. That's much more well defined. And so another breakdown of that, impulsive breakdown, that would be a sell signal. Until we get that, I don't see anything in the charts on the Qs that tells me that now is the time to be short. We did get the sell signal right here. And that was, I did get short there, but they reversed it, and it was a whipsaw signal. So when you see a whipsaw signal, you got to cover and just get out of this position at least, and we'll just wait for the next sell signal. Again, that's kind of the name of the game. When you get a false breakdown or a false breakout, you got to take action based on it. So for me, I started to cover my short position last week. On the Qs, I still have shorts in individual stocks, but on the indice here, I just didn't have the chart didn't tell me that it was a valid trade anymore. So as of right now, I still have a very small short position on the Qs, which likely I'll cover next week if if we continue to see positive prices. But as of right now, we're just there's nothing telling me that we have a sell signal yet. So again, a break of this lower trend right here, this trend line would be the next sell signal. We do have negative divergence on the daily, so that continues to be there, continuing to tell me that we're gonna break down, but we just need to wait and see that breakdown. Let's look at the SPY here. The SPY closed basically right at resistance. So this is the one reason why I still have a small short on the Qs, because the SPY broke down. Here's your March 2020 lows, and this is kind of the same trend line. We have this bearish rising wedge. See the wedge right here? Here's the top end of it. Much better, much more well defined than the triple Qs. And the bottom end of the trend line we broke. So there's your sell signal, and we came in for a back test right there. If you look at the hourly, we closed basically below that trend, just slightly. So it's too close to call. It's either we're either going to recover support just like the Qs did, or we're going to fail here, get rejected at resistance, and roll over. So I figured it was worth a slight shot on selling off. We do have on the daily big, long, extended negative divergence, and that for me, that kind of puts the higher probability in the fact that we're going to get rejected at this resistance because we have this negative divergence. And so that's kind of how I'm playing it as of yet, but it's not a full short on the indices until we see the Qs break down. When we get the, if this rejects here, the SPY rejects, and then we get the Qs breaking that trend line that I talked about, for me, that's a full short. All right. And so I will be looking for that. Okay, so we've gone through a lot of the general themes. Let's look at the financials here. All right, so as of right now, I don't see any short trade, any sell signal on the financials, but we do have negative divergence. So see the negative divergence there on the daily chart on the XLF, and it also is right. We didn't actually have that on the RSI, the negative divergence. So that is interesting. We only had it on the PPO. As of right now, if I look at the weekly chart, just to show kind of the bigger trend, this is going back to 2011, walking up that. There's your trend line. There's your break of trend. Back test again, recovery, back test the trend again, and then this last week, pretty impulsive snapback recovery. So as of right now, got to take it for what it is. It's a recovery. Until we see a break of this trend line, there's nothing there. So that's why I exited my city short the other day, and we can look at that. Here's city short. I got short on city as it started to run up into this area because that was a divergent high. There's the daily. Right in here, you can see we made a high, and yet it was a divergent high. See the momentum, how it made a lower peak and a higher price. And it did it both on the PPO and the RSI. So that's a divergent high, higher probability of failing. It did fail. So there's your drop. From the absolute high to the absolute bottom, it was a 17% drop in city. So good short trade, and you don't always just catch, it doesn't always just drop like a stone. Sometimes you're just going to catch a 17% move. And then it started to reverse, and the XLF started to recover. I exited my city trade with a profit, so that was a good trade in general. So for me, I don't see anything in this one. Again, I don't see a setup yet. Well, I'm probably going to move on until these show up as another setup in the future. Now, if we start to break down again, especially below this 60, it's about 61, 70, 75. If we start to break down from there, then, we could start to downtrend, and this negative divergence we could have continued the downtrend. But until I see that breakdown, an impulsive breakdown, then I'll just look elsewhere. And you can watch for the other financials as well. The other financials should trade down as well. JP Morgan, you can see, just continued higher throughout the week. So JP Morgan, I'm really looking for 129.84, a break of that, an impulsive breakdown of that. And if Citi and some of these others are setting up bearish as well, then that might be further confirmation. That trend line on JP Morgan also comes off the 2011, if I roll all the way back, 2011 or 2009 lows there on that one. There's your bull market, and there's your breakdown. And so far, they've recovered. So until they break down again, start to impulsively head south, that's a recovery. Which is, if you think about it, this is what the Fed intended to do. They came out right in here and said they were going to allow the bank stocks to start buying back their shares. There's technicians at the Fed. They wait for, getting to key levels, and then they announce some news trying to influence the market in the way that they want it to go. That's essentially for the most part, I've heard that's basically the Fed's biggest tool is their power to influence, not necessarily the money printing, but just confidence. Here's an interesting trade idea. Carrier Global, they're kind of a home builder. And you can see here on the daily chart, going all the way back to 2020, this is, I guess, when they started to trade. And you've got an uptrend line, clean uptrend line right there. Broke trend just recently. And it's just been kind of drifting sideways. Hasn't really fallen, but hasn't gone higher. If you look at Carrier, we have negative divergence right there. So this price action right in here was, let me just kind of circle it. There's your divergent high right in there. So you have a high probability of failing when you get a divergent high. And it did. It sold off. Is that enough to, kind of satisfy that? That was almost a 20% drop to the lows. Maybe. We still see, I still see the divergence in play. So if we run up and make a new high anytime soon, it's going to be a divergent high. The level I'd look for to break is right about here. That's your support. And if we go to the hourly here, you can see, you can kind of hone it in. It's right in that area. You can see they started to break, made it, that's a bear trap right there. They started to break and then snapped it right back. That's that whipsaw signal that we saw in the Qs and everything. Well, this started to break and then they snapped it back. So looking for an impulsive break of 36.50, and that would be your level. That would be your sell signal. So keep an eye on that. Otherwise, and this is potentially doing a topping pattern where we're getting kind of like a head and shoulders, kind of like this. Maybe we run up a little higher. That's a potential. So yeah, there's something to look at. Something I want to point out for next week, that we don't have there's no sell signal or actual trade right now, but we do have a potential trade set up on some of these solar stocks. So here's TAN. This is the solar ETF. This thing's been on fire since March, and you can see here, nice clean uptrend line right there in TAN. That's very easy to spot, and we're starting to put in a bearish rising wedge pattern. Now we only have a couple reactions up here at the top. Likely we'll see some more, but we are starting to have negative divergence as well. You see the negative divergence. So this right here, this candle was a divergent high. I suspect we'll probably get a few more divergent highs and put in that negative divergence. What I'm looking for is a break, obviously, of this lower trend line. So we're not there yet, need that sell signal. But something to look at is some of the other solar stocks like First Solar. So I actually adjusted my trend line. I used to have it where this thing was kind of violating the trend line a bunch. I adjusted it down to just give me a much cleaner benefit of the doubt trend line. And here it is walking up. And you can see we're starting to drift below that right there. So, it's showing some weakness in the solar stocks, and TAN hasn't broke yet, but that's the setup. There's a potential there. And if you look at Run, which is Sunrun, you can see this was its uptrend line right here. It broke, back tested 3 times, and kind of starting to roll over. Again, hasn't sold off yet, and so I'd look for a break of what looks to be like a secondary trend line right in about here. Right in there. So you get a break of that trend line, some sort of an impulsive breakdown that closes below, and we're likely to see some weakness in some of these other solar stocks. So that's something to look at there. And these have negative divergence right there. See that negative divergence? Lower high and a lower high on both the RSI and the PPO, and yet made a new higher price. That's a divergent high, which has a high probability of failing. And from that divergent high, the thing sold off down 30%. So is that it, or are we just getting started in a new downtrend? As of right now, I need to see an impulsive break of this trend line. I don't know exactly when it's going to do it, so I can't really call the price. But, somewhere in the $70, $69 range, something like that. Another thing to look at, which is just interesting to me, is like McDonald's. And what I really want to point out is on the weekly chart. Now, it's not a trade, it's not an idea like an actual entry point, but I think it gives us an idea of what's going on maybe in the general market. You can see this is just a staple stock, kind of a blue chip stock, and going back to March of 2003, so 17 or 18 years basically, this thing was in a nice clean uptrend. Bull market basically for that long of a time, and you can see basically that lots of reactions on the weekly chart where it held support. Recently it broke down in the COVID drop. There's your break of trend, and that's about as good of a longer term sell signal as you can get. We've had the kickback rally where it looked like it was recovering that trend line, but it's now drifting back below. It's clearly back below. So I'm just kind of looking at this. This chart, a weekly chart, sets us up for a longer term sell signal or bear market in this stock. And if you look at the daily, this is kind of the range it's been trading in, with 216.33 at the resistance line and about 207.13 as support. You can see, yes, it violated it right here when it gapped down, but instantly snapped back up and recovered. So that's why I like this line. And we start to break down. There could be longer term implications for this stock. And what does this say about the market? I don't know, but it is. This thing's been in a bull market for quite a while, and potentially going into a bear market. Pins, I pointed this one out in my last video. Uptrend line right here on the daily chart. Nice clean uptrend line. Negative divergence on the RSI. Negative divergence on the PPO. Okay, so we had negative divergence. This all was divergent high price action. Broke trend, back test, and then I didn't pick up on this one till yesterday when I noticed they reported good earnings, or the market perceived it as good earnings, and it was gapping up. So I pulled the chart open, drew my trend lines, and we were gapping up all the way up here at 86.51, which to me looked like we were gapping pretty close into resistance. What I was expecting is, they were gapping right here. I thought, okay, we could run all the way up. My trend line's moving on me. I thought, okay, we could run all the way up to about 88.75 and then reject. So I was looking for that, but the chart, as soon as it opened up, I saw the sellers were there smashing it down. So I jumped on board, shorted that thing down, and the way I did it is I got short as it rolled down. I can go to the hourly. Took half my trade off as we started to roll in. I was looking for the gap fill right in here. We got close right in here, so I took half my position off, and I'm still short the other half of the position. I like the chart. It looks bearish. We just got rejected, so I think we're likely to continue to go lower as we trend down. Nike, I'm looking to re-short this thing. Again, Nike's a great company. It's a lot like McDonald's, it's kind of a big blue chip staple stock. Here's your March 2020 lows. Nice uptrend line right here. This is an hourly chart we're looking at. You can see bearish rising wedge right there. We overshot it once, failed, overshot it again, failed. Again, when you see the overshoots or, a move up in a bearish pattern, usually those don't last very long and they sell off. So we overshot it again, and then we completely came down, broke all the way, we broke the trend line here, back tested again, and then just failed and rolled over. We hit support right there at 131, and we're now getting, to me, what looks like a bear market rally or, a counter trend bounce. The trend I see is down. This is a counter trend bounce and looking for lower prices. So next level that I think we're going down to is this 117. It's about 117.64 up to about 120, we'll call it. That's the next zone of support. What I'm looking to do is re-short this thing. Now, if it wants to run up and do a full back test up at this 148.91, let's look at the daily chart here. If it doesn't soon, say next week, runs up and hits that, or maybe we open up there, it's going to be a divergent high. So you'll see we have negative divergence. That remains intact. If we run up and hit that, that will be a divergent high, making a new higher high right into resistance with negative divergence in play. That's as good as it gets when you're trying to short something. It doesn't mean it's going to work, but that's the best setup you can look for and hope for. So I'll be looking to take a position there, ride this thing all the way down to that buy zone that I just talked about. I think if we're heading down there and we get down there, it's very likely that we're going down to the longer term support line on the daily chart, which comes all the way back from 2009. So here's your bull market in Nike. And you can see there's a support line down here. So down around $100 or so. Someone asked me if I was still in PayPal. No, I exited this one. Had to get out when they gapped it up. And I took a look at the trend line again. I kind of readjusted it. And so this is the trend line that I have now. Again, when as you get more data points, you can adjust your trend lines. That's there's nothing wrong with that. We do have a bearish rising wedge in PayPal, and we do have negative divergence. It is it's still intact. So, but that doesn't mean we can't continue to kind of grind higher within this wedge. So rather than just ride this thing short higher within the bearish wedge, waiting for it to break down, I'll just let it go and do its thing, and then when it wants to break down, I'll jump on board at that time. I'll jump back in at that time. So one way that you can really avoid taking huge losses on something just gapping against you is position sizing. I teach that in my course. Link is in the description below. But again, it's all about position sizing. I don't take just a huge position in one stock and then a really small position in another. I try to keep my positions relatively equal. Let's say you take $10,000 on a trade, then, when you find a trade, take $10,000. That's a unit, treat it like a unit. And so one unit will work, maybe another unit doesn't work. Not all trades are going to work, That's the point. Nobody gets 100%. All right, you hope to maybe get 70% or so, and then when you let your winners run and you cut your losers short, and that's how you make money doing this. Peloton still looks good for shorting. Here's your hourly chart. You can see we're kind of making lower highs, kind of downtrending a little bit. We've got this base of support, which is right around 144.90. It's kind of hanging there, not wanting to break, but it's coiling to the downside. And this pattern usually is going to break to the downside. So we're just kind of coiling. I think it's likely we break down. Looking at the daily here, negative divergence. It showed up right here. That was your divergent high. That was your first divergent high. This was a divergent high, and that was the last divergent high that we got right there. And so these divergent highs have a higher probability of selling off, and they have. You know, ever since you get a divergent high, sold off. You get another divergent high, sold off. As a trend, you can see on the daily chart, we're walking up this uptrend right here, broke it, back test, and now we're kind of drifting sideways. I think we're heading lower. Where are we going? Well, you know, I do think we're heading down to this $80 area, and we'll see once we get down there, or if we get down there. Next level of major support, once or if we break this support shelf right here. As far as I can tell, because this chart is not the cleanest chart, you know, I've tried to find. You know, you've got this big gap right in here, so we might find some sort of reaction right around that gap, maybe around 111 or so. You know, we've got this reaction cluster right in here, so that's why I've got this one marked out down at 80. Within here, yeah, I'd have this trend line right here. Maybe, you know, that was some resistance right in that area, and it looks like it held us some support, so we'll call that one, you know, we'll call it about $100, but it's 98 or $99 right in there. We might find some support right around that $100 round number. Qualcomm, so Qualcomm broke, and this is a semiconductor, and the semis often will lead the market. You know, the tech sector at least. You look for them to kind of lead. Qualcomm just broke support. So here's your upward channel from March 2020. Nice clean upward channel. This rise, you know, from the lows all the way to the highs was about 180%. So that's a pretty good rally. And we just broke right now. So here's the daily chart. We had negative divergence. I pointed this out. I talked about Qualcomm for a while, waiting for it to break, and it did just break. So there's the daily sell signal, broke right there. You did a back test, and then boom, impulsive failure. That's a bull trap as well, where you just gap down like that. That's trapped all the money. Anybody that took all this trading action within here is now either break even or at a loss. And so looking for this to continue lower, we got a gap down here at 130. That's the obvious reaction point. Because this one's so obvious, this gap is so big and so obvious, I think it's likely we get the reaction before 130. I think we'll probably head down to, say, 133 or something like that, and then then you'll get the bounce. You'll get some sort of a reaction. So keep an eye on that. Zillow Group, you can see on Friday, this is a daily chart, this uptrend channel right here. See your upward trend line. And all that price action was divergent high price action. See the negative divergence? So this is all negative divergent high price action. Waiting for the break of trendline support is your trigger or your sell signal. There it is right there. And you got the confirmation, a follow through candle. So that's a sell signal with confirmation. That's good. You get the back test, and they gapped it right up into resistance. And let's see how the day closed. You can see on Friday, they ran it up, made it look like a recovery, and then it failed and faded back below resistance into the close. So again, that's as good as you can get. There's no guarantees here. It's just all about playing the probabilities. We have negative divergence. It recovered and then failed. Reading this price action tells me that was your whipsaw, and now you're failing and you're heading lower. Okay, that's all I got. Just looking at how we closed over the weekend. So I'll get this out there and catch you guys on Monday.